Hey everyone, welcome to another episode of Mayhem's Macro Monday, coming to you July 11th. On screen, we've got a chart of the big four central banks, the Fed, the ECB, the BOJ, and the BOE. PBOC is omitted from this chart, but it probably helps a little bit because they're on a different credit cycle anyway. So what you can see is a projected decline really over the next year, and that matters because central bank asset expansion was really the biggest driver of liquidity in these markets. It was a big driver of upward price discovery, and that's really with central banks buying various assets. They pushed prices higher in stocks, bonds, real estate, even things like crypto. And so when they're set to remove that same liquidity, which they started to talk about in January of this year, really more seriously, and remember I did put out a video on January 4th saying this would be the end of the bull market if they're serious, and they started to show more and more that they were serious, and that did play out. And I'm sad that it did, in the sense that I really, the amount of wealth destruction has been unprecedented. It's the greatest in history that we're aware of. So a lot of people have gotten hurt, and that does make me sad. But at the same time, we do need to take a step back and just look at the big picture, which is this is the biggest multi-asset bubble that we've probably experienced in human history, and it's probably also the largest amount of globally coordinated central bank interventions in markets over the last 13 years, on and off. And so at some point the party did have to come to an end, and it's coming to an end in a rather unceremonious way because inflation pushed central banks to act a bit more aggressively than I think they would have otherwise. And so it's becoming a historic route in a lot of ways, both in terms of the harmonized deleveraging across multiple asset classes, as well as the depth of the route. So let's continue forward here. The next chart we have is the amplitude of change in M2 money supply growth trends, and how that impacts GDP growth. So we can see that really, as M2 rolls over meaningfully, it can have an impact on GDP. It's not necessarily a direct impact. Sometimes there's a latency. Sometimes it's an after effect. So I wouldn't say it's a high correlation, but I do think that it does tend to have an impact on GDP, especially, from basically 1990 on, when everything was so much more driven by debt. So much more driven by the expansion of, accommodative Federal Reserve policy and fiscal spending by the government, and so much less driven by organic economic growth and business activity, and also driven by the FIRE economy, or the financial insurance and real estate economy, really growing so big that it shifted from being a lubricant of growth to a parasite of growth in the economy. And I think the great financial crisis really tried its best to make that clear to everyone, but very few were willing to listen. So we can see with the Federal Reserve constraining M2 money supply growth, and bank lending, likely on the decline. We already see banks pulling back from more risky borrowers in auto lending, and we see less people lining up to get mortgages because house prices where they are, and mortgages at the rate that they are is just too expensive for a lot of people. So a lot of folks is kind of pushed out of the market. So money supply growth is going to be slowing for a lot of different ways. And I think it makes sense that the economy would slow as well, because this is a debt-driven economy. I think it takes about $9 of federal government debt for every $1 of GDP growth. And I'm not saying it's necessarily a one-to-one relationship, but it's important to think about an economy that's very driven by fiscal spend and monetary policy inducing an environment of lower and lower rates. When that cycle reverses, when fiscal spend becomes constrained because of those higher and higher rates that we're starting to see, that is going to have a deleterious impact on economic activity. And it's going to go all the way from the household to the business to the government. And that kind of feeds into each other. And we're seeing a weakening economy as the Fed's tightening. So this is also somewhat unprecedented, that we're probably in a technical recession when we get the quarter two GDP print for this year. If we look at the Atlanta GDP Now model, we can see it's already projecting a negative 1.2% print as of Friday. So that's something to take into consideration as well. That really, we still have potentially more pain to go in this decline of this credit cycle. And as it unwinds and we go through a recession, the Fed is still at least seemingly inclined to further tighten, which could exacerbate that pain in the form of more business closures and bankruptcies, more unemployment, and more people that are just very cash constrained, and they've already gone into debt trying to make ends meet to pay for their home, their utilities, and so forth. So there's a lot of consumers on the bottom end of the spectrum that are not doing so well, and that's going to have a drag effect as that problem permeates higher and higher echelons of consumers. And, this has also been a really, really bad year for bonds. And it's not just bonds in the U.S. And that's something that I think is really important to take into consideration, because we've had a lot of talk of, oh, the 60/40 portfolio is dead. And, the U.S. bond market's in this bear market, or, at least in a pretty historic decline. And yet it's not just us. It's really central banks around the world have been constraining monetary policy. The abundance of liquidity is turned into a scarcity of liquidity, and that has impacts all over the place. So if this return that we've seen year to date were to be annualized, it would be the worst year on record since 1865. Now, it's anyone's guess where the rest of the year goes. No one knows. So that's why this chart is a little jokey, but it's important just to show the scale, because it is a pretty significant route. And even if it wasn't to be annualized, it's still the worst route in bonds unless they have a miraculous recovery in decades. And I think that's important, because with everything kind of being built on top of a foundation of debt-driven growth, when rates go up, leverage has to come down. And when leverage comes down, it slows down the economy. It takes the wind out of the sails of any kind of risk assets. And in this case, we see multi-asset deleveraging. Another area you're seeing a selling out of recently is commodities. There's a lot of crowding into commodities, and now people are starting to exit those positions, and sometimes in a relatively disorderly manner. And that's part of that same liquidity issue. Part of that is driven by liquidity. Part of it is also driven by an increasing fear of recession over inflation. Now, when we go to emerging markets, we see that the trend there is no different, that annual net flows out of emerging markets are actually at their worst level on record. And this is worse than the great financial crisis. It's really a significant exodus that is happening. So it's something that I think is important to take into consideration, because year to date, annual flows out of emerging markets are the worst on record. Now, again, it's anyone's guess as to where these things go as we move forward. But I think it's important to reflect that, when you see that kind of an exodus, it does have a jarring impact. It slows down economic activity, not just here, but all over the world, as a lot of other countries also rely on debt to fund growth. And so a lot of these emerging markets are struggling. They have a lot of dollar-denominated debt, which is one reason that we're also seeing such demand for dollars here. And I think that it's something that we want to keep an eye on as this crisis goes on, because we do have the potential for some of these things to start to spiral out of control and become a bit of a domino effect. I'm not saying it would usher in a new financial crisis, but the chances of that happening are higher now, with central banks around the world tightening into an environment where households, many companies, and a lot of governments are pretty well leveraged, and they may not be able to sustain the increase in rates, especially if it's over a longer time period. Speaking of indebted countries, look at Japan at well over 250% debt to GDP. And that's not great, because what it does tell us is that, we've got a lot of countries, Italy, the United States, Spain, France, most of the Eurozone, that are in pretty dire straits in terms of just the amount of government debt they have. This is just really national government debt. Like in the United States, it doesn't count state and local government debt. It doesn't count unfunded liabilities, which would bring us up to a level that's not too far from Japan if we did count all of that government debt. But in other countries, it's similar. They're not counting all of that sort of province or state or local government debt as well. So these numbers are actually much higher. And then if you factor in corporations, if you factor in the banking system, if you factor in private households, these numbers start to become staggering. And it's just because you have to think about, if a country has that much aggregate debt to their GDP, what are the chances that they can realistically pay it off without subdued interest rates? So then what happens when interest rates, it's not even normalization, but just start to creep higher? Well, nothing good happens in that environment, as we can see. And the countries that are more indebted on this chart are more vulnerable. And we have seen the spread between Italian and German bonds blow out. And the only reason the Japanese bond market hasn't completely imploded is the Bank of Japan is buying hand and fist everything they can to try to control the yield curve. And in doing so, they're trashing the yen. So it's having other impacts that, while rates are stable, there's basically exchange rate concerns that are coming on board at a time when a lot of their imports have gone up in price as well. So it's introducing, for the first time in a very long time, the idea of inflation in Japan. I mean, for decades they've been trying to find inflation. I don't think they wanted it quite like this, but this seems to be the destiny that's written in the stars for now. And that is going to have some longer term impacts potentially in Japan as well. So I think it does matter, whether or not they start to defend the yen. If they don't, then those longer term impacts could just be higher costs of imports. And Japan imports a lot of energy. They import a lot of food. So that could have some quality of life impacts as well. Looking at real estate in the United States, Here are some of the areas that were thought to be very overvalued based on Moody's Analytics. And the reason that this chart's interesting is it actually ties into the next chart. So we're going to go to the next chart in just a second, but just try to remember where some of these areas are. There are a lot of coastal cities that are involved with these overvalued areas. And now the next map is where price cuts have happened and the biggest price cuts. And you'll notice it's not all that different. It's a pretty similar map. Coastal cities get most of the attention. There's a little bit in the Gulf and Texas that was also getting slashed. We're seeing the same pattern here. So the most overpriced areas are predictably the areas with the largest share of listings with price cuts, which makes a lot of sense, right? But it's the beginning of the leg down in housing that we're paying attention to. And it matters here because the housing market is one where it tends to move more slowly. It's less liquid. Like people aren't just buying and selling houses on a high frequency basis like they might stocks, bonds, commodities, crypto. So it takes longer for these changes to be realized in the housing market. So we're starting to see the sort of inevitable decline in this asset class as we see rates rise, as we see many buyers that have been priced out, not just because of the price of houses, but also because of the cost of having a mortgage. And that's going to have an impact because housing is a big chunk of GDP, about 15 to 18%. So when a lot of people are priced out of the market, that inevitably slows down economic activity. We also see there's been a lot of talk about a very strong jobs market, and yet when you look at data about the gig economy and when you look at data about people who are self-employed, it doesn't make up for the lack of labor force participation. It certainly helps to explain some, but not all of it. And so we have had this labor force participation rate that's been sort of every crisis sequentially never recovering, whether it was the dot-com bust, the great financial crisis, the COVID crisis. This has just continued to decline and decline and decline. And that's something that I think is worth paying attention to because, when the Fed was justifying loose monetary policy in 2021, Powell and other members kept coming back to this read, that the labor force participation rate and really also the distribution of income and inequality in the labor market was just all a big concern. They wanted to address it by having stimulative monetary policy. Well, all the talk of the really tight labor market doesn't really get into the fact there's a lot of people that just aren't participating in the workforce for whatever reason. Now, obviously, some of them aren't measured as employees because, again, they're 1099 missed contractors that are in the gig economy or they're self-employed, but that does not explain the lack of a recovery over so many generations. And I think that's something that we should pay attention to because as this recession progresses, this is going to look worse because there's going to be even less people participating in the labor force, and that is going to have an impact on a consumption-driven economy, because there's going to be less people with less money to consume, and debt's going to be more expensive. So it's a sort of coalescing of forces that create a bit of a vice grip effect on consumption, and consumption is the key driver of growth. So when the population that is participating in the workforce is declining, and it's across multiple age groups, it's not just all retirees, that is sending a message of concern. And when the talk of, hey, we're having to tighten policy because of this very strong, sort of labor-driven economy, it's not really the case. The reason there's so much competitive bidding for people to get into the workforce is in part because there's less people getting into the workforce, and there's still a lot of jobs. So that's a problem. The recession that's coming is more than likely to alleviate whatever perceived tightness exists in the labor market, but it's going to be more because there's going to be less available jobs and more people in the workforce and a labor force participation rate that's already historically low. And we also have another problem that compounds that. The U.S. population rate of growth is the lowest it's been, since the late 1910s. And that's pretty much like the World War I effect, right? That's part of it. But another part of it is really that what we're seeing here in the now is COVID, right? COVID crashed population growth. I mean, if you can't go out, you can't date, you can't, really get married, you can't do normal human things, you're probably not starting a family either. And that's had a big impact on a country's population growth rate that was already too low to be self-sustainable. And so when you see a low labor force participation rate, most people are, are in the workforce, but there's a whole lot of people that are not, combined with a low population replenishment rate, those are two areas of concern. Because what you have is you have an increasingly aged population in this country, and they're not being replenished by people who be able-bodied workers in the future. And so unless we really open up the doors to immigration, which we should, and that's not really a political argument, it's an economic necessity argument, unless we open up those doors, we're going to have some serious problems with our economy moving forward, especially within the next 10, 20 years. So it's something to take into consideration because population growth has been stagnating in this country, as you can see on the chart, since the end of World War II when we had that sort of baby boomer era. But what we've seen of late and the fact that it's not really recovering very well is a big, big concern. This is a chart that got a lot of attention on the Twitterverse. I put it out there with the suggestion that maybe gold would sell off. It kind of went viral, and some people got really upset about it and said things that were kind of, a little unfortunate on their part. Let's put it that way. I just put this out because I thought the correlation's interesting, and it goes back over a decade. So does it mean that gold has to go down? No, it doesn't mean that it has to go down. It's a chart. People need to calm down. Sometimes they think charts are like prophecies or something. But what it does suggest is that real rates are rising to the point that it could inflict further pressure on the price of gold. And as we've seen that in the past, when the last major gold rout happened, we did see that real rates rose. Gold fell first, but real rates rose a lot. And the gray on this chart is real rates inverted, right? So, look, the chart suggests an outcome. The outcome might happen, but it's still a chart. And people need to calm down a little bit about charts. They're just charts. So, we'll see what happens. Real rates rising does typically put pressure on gold. Is gold going to automatically go to zero if the real rates rise too much? No, I don't think it will. But I do think that real rates rising will put pressure on multiple different types of long duration assets, including precious metals. China housing is recovering. It looks really, really interesting here because this was an area of the market that was of huge concern. A lot of people are saying, they're going through their next, real estate crisis. It's going to be like COVID. It's going to be like the great financial crisis, yada, yada. It doesn't really look like that's the case because we're seeing significant housing sales recoveries as some of these COVID lockdowns are coming off. And I think that was the big driver of the decline. It wasn't, just that the economy is softening. And it is. It is. The Chinese economy is not in amazing shape, but it may just be starting to begin their next credit cycle. But I do think that this chart does suggest there's some cause for optimism because when people are given the opportunity, they participate. So when they're not in a COVID lockdown, they come right out and they start buying houses again. So there is a buoyant middle class in China. It's actually the largest middle class in the world. It's a slightly different definition of middle class, but it is emergent. It is key, and it is pivotal to PBOC and really just the Communist Party of China. Their policy is they want to grow a consumption-driven economy, and they've been wanting to do this for over a decade, and they're putting more and more effort even in their latest stimulus to accomplish exactly this. And this chart shows you that with some degree, when people are left to their own devices and they're not locked down because of COVID, they will consume. So that does alleviate a little bit of stress, in the property market, in the development market. It is a healthy sign. It doesn't mean the worst is necessarily behind, but it's a sort of green shoot to pay attention to. We also see a lot more companies talking about supply chain shifts during corporate presentations. A lot of those supply chain shifts are talking about bringing them home, bringing them somewhere else that's closer, or bringing them just somewhere else entirely, right? Just a lot of people are probably a little fed up with China right now, quite frankly. I think that's what this chart strongly speaks to, is that the lockdowns are causing a lack of confidence in China. And it's obviously not just there. There's other reasons to bring things home. The supply chain itself is a big reason. All the bottlenecks, the inability to move product, the amount of disruption that caused. People want to bring production home wherever they can. Robotics, automation, those two things combined will help to make that idea a reality in more advanced countries where there's larger labor law enforcement and actual laws that protect people. That you can't necessarily have slave labor directly in the United States, at least not anymore. But you still have it in places like China. You still have it in places all over the world. But, if you have robots doing the work and you're doing a lot of different types of automation to do that at a scale that is more efficient, that is more efficacious of resource utilization, there can exist a world where, making things at home is actually more cost efficient, more time efficient, and gives you a competitive edge. And I think that's one of the things that this chart is speaking to. So I think it's a very interesting change because it's been building. You can see that, really since 2020, 2021, quarter two, it's really been building and building and building and building, especially the interest in onshoring. So that wraps up my chart deck for everyone. I want to thank everyone for listening. This whole thing was sponsored by TraderAid. You can check us out on the web at traderaid.com. We're micro to macro. We look at all kinds of parts of the market, whether it's commodities, whether it's equity futures, bonds, foreign exchange, stocks, options. We try to provide education and information, trading ideas, interviews. We also have courses and classes. I do one-on-one coaching and group coaching, and my buddy Misha Gandalf, who co-founded TraderAid with me, also has a class that he created about trading the opening range. So check us out on the web at traderaid.com. Also check out my YouTube. I daily run a stream where I put on Bookmap and Motive Wave and look at S&P futures and occasionally provide commentary. And we've got a great community there. So you can just like and subscribe, turn on notifications. You'll get notifications about those streams when they're live. Typically starts around the time the trading day starts. And then finally, check me out on Twitter if you don't already. Mayhem 4 Markets, Mayhem number 4 Markets. You can follow me there. And like and subscribe to this YouTube. Again, if you enjoy the content and you want to see more of it, I really appreciate your support. So that's all for now, folks. Really appreciate you tuning in. I didn't want to take up too much of your time on this Monday evening, but I think all this stuff is pretty interesting and useful. So if you have any questions, feel free to leave them in the comments here on the YouTube video itself, and I will try to answer them the best that I can. Until next time, this is Mayhem signing off.